Have you ever stopped to think about the sheer scale of the decisions that keep our lights on? We're talking about investments so huge they shape entire nations, and they run into the trillions of dollars. But with so much at stake, how on earth do we decide which massive projects actually get the green light? Well, that's the trillion-dollar question we're going to tackle. I mean, think about it. From the moment you flip a switch in the morning to the grid that powers our cities all night, our lives are basically built on top of this colossal, often invisible infrastructure. These aren't just construction projects, they're the absolute lifeblood of modern society. And that's the real challenge, right? We can't build everything. Every dollar, every single ton of steel that goes into one project is a resource we can't use for something else, like a new hospital or a school. So the question becomes, how do we make the smartest choice for everyone? Okay, let's dive into this. To really get a handle on the problem, you first have to appreciate just how unique it is. You see, energy projects aren't like opening a corner store. They operate in a whole different universe of time, money, and consequences. These things create a perfect storm of complexity. First off, they are wildly expensive upfront. We're talking 2 to 3 times more capital heavy than manufacturing. Plus, the assets are super specific. You can't just decide to turn a nuclear reactor into an apartment building later. They last for decades, meaning a choice we make today has ripples into, say, 2070. It can take a decade just to get one built, and to be efficient, they have to be huge. You're basically making a gigantic, long-term, inflexible bet on what the future's going to look like. So, how do you make a bet like that with any kind of confidence? Well, economists have a really powerful tool designed for exactly this kind of thing. It's called cost-benefit analysis, and it's pretty much the golden rule for figuring out if these massive investments make sense. Now, on the surface, it seems almost laughably simple. Step 1, add up all the costs. Step 2, add up all the benefits. Step 3, if the benefits column is bigger than the cost column, you give it the green light. Simple, right? Well, the real magic and all the difficulty is in how an economist actually defines costs and benefits. And this, right here, brings us to the very heart of it all. A true economic analysis looks way beyond the price tags and the receipts. It forces us to hunt for the invisible costs, the ones that never, ever show up on a balance sheet. First up is something called opportunity cost. This is really just the value of the thing you didn't do. So if you spend $1 billion on a new pipeline, that's $1 billion you couldn't spend on, say, building new hospitals or a high-speed rail line. The opportunity cost is the benefit society misses out on from that road not taken. Then you have sunk costs. This is money that's already gone, and you can't get it back. It's like a non-refundable concert ticket. If you get sick on the day of the show, the money you spent on that ticket is totally irrelevant to your decision to stay home and get better. And economists are absolutely ruthless about this. What you've spent in the past should never influence your choices about the future. Now, this one is huge: external costs, or what economists call externalities. Let's say a power plant creates pollution that harms public health. That is a very, very real cost. But it's not a cost that the plant's owner pays for. It's a cost society has to bear. A proper economic analysis has to find a way to put a price on that harm and add it to the cost column. And finally, economists just ignore what they call transfer payments. Things like taxes or government subsidies don't actually use up a country's resources. They just move money from one pocket to another, from a company to the government or the other way around. Since we're looking at the whole country, we leave those out. Okay, so we've figured out how to spot all the hidden costs, but there's another really crucial piece to this puzzle: when these costs and benefits actually happen. This brings us to a fundamental concept in all of economics: the time value of money. It all boils down to this one simple truth: $1 today is worth more than $1 tomorrow. And why is that? Well, because you could take today's dollar and invest it to earn interest. So to compare a cost today with a benefit that happens 20 years from now, economists use something called a discount rate. It's kind of like an interest rate in reverse. It lets them translate all that future money back into today's dollars, so they're always comparing apples to apples. Let's make this real with a super simple example. An energy-saving light bulb costs more upfront, $2 versus just 50 cents for an old one, but it uses way less power, so the benefit, the savings, comes later, over time. So how do we know if paying more at the beginning is actually worth it? We can calculate what's called the payback period. That new lamp saves you about 6 cents every single day. At that rate, it takes just 25 days for those daily savings to completely cover the extra $1.50 you spent at the start. After day 25, it's all pure savings in your pocket. This is a perfect little illustration of how we weigh an upfront cost against a stream of future benefits. All right, let's pull all of these threads together. Because once you understand invisible costs and the time value of money, it leads us to the single most important distinction in this entire analysis. This is the big one. So here it is, the crucial point. A financial analysis asks one simple question: will this project make a profit for its investors? But an economic analysis asks a much bigger, much more important question: will this project benefit society as a whole? It measures the true national benefit, and that means it includes those external costs like pollution. And critically, it values things not just by their market price, but by what society is truly willing to pay for them. Think about the value of clean air or a beautiful public park. This is why a project can be insanely profitable for a company, but still be a really bad deal for the country. And the tool they use for this is just fascinating. Economists calculate something they call shadow prices. It's basically an estimated price for something that isn't sold in a normal market, like the cost of traffic noise or the value of preserving a pristine forest. It's their best shot at putting a number on the true, full impact on all of us. So what's the big takeaway here? What does all this mean for you? Well, you now have a new economic lens. The next time you hear about some massive new project, a dam, a pipeline, a power plant, you can look beyond that simple financial price tag. You can start asking those deeper questions. What's the opportunity cost here? What are the externalities, the hidden costs and benefits for everyone? Who truly profits and who really bears the cost? You see, this framework doesn't just belong to economists in some ivory tower. It's a powerful tool for all of us to better understand the trillion-dollar decisions that are shaping our world.